All right, Peter, stick around. We want to bring in one more macro voice. That's Mona Mahajan, Senior Investment Strategist at Edward Jones. Mona, thank you so much for being here with us today.
Thanks, Frank. Good to be here.
So I want to ask you the same question I started off asking Peter. How do you see today's slightly hotter than expected CPI print impacting the markets as we wait for the next Fed meeting and the next Fed rate decision?
Yeah, it was an interesting reaction from both the equity and bond space. I think the equity markets tended to focus on the trend of CPI. So this is now the 7th month in a row that headline CPI has fallen back when it peaked in June of 2022. And so equities were actually quite benign or sanguine when they saw a print that was perhaps slightly above consensus, but still the trend has been their friend in the equity market. And keep in mind, this is a backdrop where not only inflation has been coming down, but we are seeing, of course, a very resilient labor market. And to your discussion earlier, China and Europe have been showing resilience as well. So coming into 2023, a much better backdrop overall for equities and risk takers broadly. But on the other hand, when you look at the bond space, the reaction there was quite interesting as well. Yields across the board, including the 2-year and the 10-year, moved higher. And in fact, the 2-year is now at a high for the year. And that yield curve continues to remain pretty inverted here. So usually a reliable signal of a pending downturn ahead. And also, of course, as you and Peter were talking about, the Fed funds futures. And if you look at the CME FedWatch tool, in fact, there is now an increasing probability of not only 2 more rate hikes, but potentially a 3rd one in June as well. So certainly before today and after today, the potential for Fed rate hikes, at least that are being priced in by the market, has increased as well. So we're looking at higher, potentially higher for longer, but still an equity environment that is still seeing the silver lining.
Okay, so I know that inverted yield curve is supposed to be a potential recession indicator, but there's something that's not going higher. That's the unemployment rate. With such low unemployment, does that just completely refute any sense that we're heading for a very big economic downturn with, record low unemployment?
Yeah, the unemployment rate at 3.4%, multi-decade lows, that is not screaming an imminent recession. Now, some of the other indicators you can look to, and in fact, the retail sales number tomorrow will be quite interesting, but we are seeing softness in forward indicators, leading indicators, and of course, the ISM, not only in manufacturing, but now in services, is starting to roll over. So there are signals in the economy that we could be facing a softening ahead. But I think our core view is that because we are starting from this position of strength, we don't see a potential for any sort of deeper, prolonged recessionary environment. In fact, An economic downturn may look more like a slowdown to below potential growth instead of your technical, 2 back-to-back quarters of GDP growth. Negative GDP growth. What I will mention, though, earnings. If you look at market forecasts for earnings for 2023, what we are seeing is not only Q4s of 2022 is looking at negative 5%. We're now looking at Q1 and Q2 at negative 5% and negative 3% respectively. So that's 3 back-to-back negative earnings growth quarters. That is pointing to at least an earnings slowdown that could be somewhat related to the GDP growth as well.
Mona, this is Peter. A quick question. Do you think the stock market can withstand this level of interest rates as the year progresses?
It's a great question. We are in an environment that is completely different than the 10 years post the financial crisis, where the Fed brought rates to the zero bound. And in fact, in that environment, growth outperformed value, as we know, for almost that entire 10-year period. When you look at where your winners and losers will be in this environment where not only are interest rates elevated, but probably will stay elevated for some time, we think what's important for investors to understand is that there's probably going to be a balance in leadership. Yes, we are seeing growth and technology rebound for this first quarter, but more, longer term, we think diversified leadership between value and growth sectors makes a lot of sense. But to your point, we do think an inflection point will come when not only the Fed pauses their interest rate hiking cycle, but of course, when they start thinking about moving it lower, we think that will set up nicely for a market rebound. And that could happen, of course, not only because growth is slowing, but also potentially because inflation has come down and they don't need to be at such a highly restrictive level.
So, Mona, you're hitting on one question I want to ask you about is just the investor appetite for risk. So far this year, we've seen a big appetite for risk. How much longer do you see that trend continuing?
Yeah, you know, it's a great point. In fact, coming into the year, a lot of investors were underweight. We saw a lot of those fund manager surveys showing cash at the highest levels we've seen in recent history. And in fact, the probability of recession was much higher coming into the year. We've slowly seen that come down as well. All of that lends itself to better risk appetite broadly. Investors were very underweight in some of the technology growth parts of the market, and we're seeing that rebound first. We do think that the appetite now, not only from the equity space, but also the bond space. Keep in mind, last year was the worst year on record for balanced investors. If you had a 60-40 portfolio, if you had exposure to equities and bonds, this was the first time in a long time you did pretty badly in both. So I think the appetite now, we're seeing rebounds and potential for price appreciation, not only in the equity side, but on the bond side as well. So we do think that that will have some legs. And in fact, when you look at the technicals, S&P 500 still very much above 200-day moving average. Same with the NASDAQ and the Dow. And in fact, in the bond space, we're up about 4 or 5% as well.